SMF, Worldwide Economic Update. And what is the economic update? We do them a little bit different than a lot of other people. What we do is we really cut out all the middle tape and we just get right down to the facts. This way you can hear it all very quickly, and then it's your choosing. You can ponder it the way you may or may not. Now, as of calendar date 1/26/2012 at 5:57 a.m. Pacific Standard Time, that's the time, you know. And it's 2012, and it's 29 days, or it is exactly 26 days deep as of starting this morning. One of the things that occurred in the economic processes is that the liquidity injections worldwide are running at a full steam capacity level. Why? Because worldwide growth has contracted to depression levels in 2011 from the very first round of 2009 stimuluses, which you're seeing going into a 3-year period, going into a 3-year period there coming up, is that from the date of the U.S. injection, you have played that growth that stimulus got in the economy, but nothing was ever done right in Congress. We don't need to go around that. However, what you want to know is that the actual tier growth levels are at levels, loss of liquidity around the world. Now, we talk about liquidity, we talk about central banks. Not only do we talk about central bankers around the world, but you talk about your Mr. Federal Reserve man here yesterday, who is basically trying to send a message, and the wrong messages, in my view. However, it doesn't matter what our view is. Good views are overlooked and bad views are implemented. What I will tell you is that the amount of short-term liquidity, once again, what happens is when you inject liquidity, you're trying to buy a higher growth rate. Now, worldwide, they all had to come together behind closed doors, as they did, and they worked out what all of this would be, because they knew that they could not grow their economies, nor could they grow their populations, as populations around the world were extremely violent in 2011 behavior. And because of the pent-up demand, the amount of taking from reality to exuberant levels, highly exuberant levels, this is where the tape is going to go to a certain level in such a short period of time that there will be some sort of train wreck that will come around the corner, as it will. However, the average people that were hurt very badly over the last, let's just call it 5-year period, that last washout in 2008, and then the one that we had in 2011. We had a mini washout in calendar 2011 that we had called for. But we also know that part of the bull case for the bull is that they're going to make all of these injections and do these things. Hey, they work as far as marking up liquidity, and they will work marking up dollars. But once those dollars are marked up again to levels, they still have the underlying growth issue to deal with for one reason. The reason being would be that you can only put so much dollars in to control the current environment, meaning that the liquidity damage is liquidity damage. And dollars lost are dollars lost. And economies have to regulate and cycle capital through their consumer payroll societies around the world. And what we clearly see is the beginning phase of it. Now, whether it works a month from now or later, even in the day, who knows We'll be here to figure that out, though. But I will tell you that the amount of caliber of exuberance is past behavior that was created like in the 30s, or it was created like you seen irregular behavior like in 1999 when they went up to the top in 2000 and totally cratered. And you seen that top there in 2007 and 2008 totally cratered. Yeah. Then each stimuluses that are injected, the markets climb to short interest in the market. They want to change the perceptions and the realities is what they want to change. They want to change those realities, those perceptions, so that you would believe that you would throw your money at the top of a very short-term movement with Fed liquidity injections, worldwide central bankers. They're all meeting over there in Davos right now. Mark to market, marked down. The world has marked its growth down around the world as they have. And the U.S. marked themselves down. The Fed here in the U.S., it's the U.S. that orchestrates all of these great TARP plans and all of these injections. Yes, you can buy growth with dollars. You can turn economic indicators with dollars. Yes, as they turn, what happens is, like always in Wall Street, is that people are going to get caught both ways. It's easy to get caught on the downside volatility, and it's easy to get caught on the upside volatility. It'll work both ways. And that most of the earnings around the world have been marked to market down, and this must be clear. Prior to coming into this quarter, because it was already weaker in Europe, mark to market liquid assets were being marked to market down in value as they were. So that means the deleveraging process, that means the actual markdown of that dollars or currencies around the world, let's put it that way. That's an easy way. And now that they've gone through this whole little escapade, is that part of the upside is to make you feel that the world has changed, but you need to know that money or liquidity, central banking, worldwide liquidity injections is the key player. And yes, you can try to buy earnings, and we could go into a lot of that. Right now, the market will. S&P is at that 1326. I'm going to be putting alerts on it up there around that 1338 handle. And the S&P has not recovered the 2011 high yet. They have been walking that tape artificially in pre-market futures and taken all of the events worldwide, and rather it be overnight and or in the morning time in New York Eastern time, that is that we see where the markets are trying to send a false signal to people, because the people need to know how to separate liquidity injections, whether it's the full-blown QE3 here, as it will be. Listen, you don't do QE3 here, and central bankers around the world don't do all of this if things are great. They don't. My message is to you that you process what I have said and what you have truly have come to a conclusion to, is that the liquidity injections are full-blown as of 1/26/2012. Yes, it's early in the year. Yes, will they have consequences to them? Generally, when all of the hyperactivity and the exuberant activity, as it plays its course, it has a role. As these roles are played mechanically with an intrinsic value to them, is what is the difference between, we got a majority amount of bulls on the sideline right now that would like to get in the market, because now what ends up happening is that these injections also change the sentiment. They want to pull that money off of the sideline. You got lots of money on the sideline, have had for a long, long time. But remember, they pulled all that money off the sideline. They shot these markets straight up to the highs in 1999 into 2000, clobbered the public. Not only that, they came back in 2008 and even took it down another level lower. And this is the part of the current environment that you're in within the bottoming processes that took place in calendar 2008, January, February, and kabam, we put the lows in February. So this type of January tape is coming artificially, pumping news out of the central banking community worldwide, Federal Reserve worldwide, earnings that have been previously marked down, marking worldwide growth down, marking U.S. growth down, because as part of the bull case is that you got to wash some of that out of there. However, that's the way the tape is. However, there remains a lot of money on the sideline that refuses to come in here and buy these highs. They're going to wait for a pullback. And when they get it, that means that that mentality, that sentiment's changed, and that's where more people are going to want to make an engagement. Right now, why would anyone want to? They see that the tape is up, and they can't figure it out. The public isn't buying into it nearly as much as they used to, but they still do. They still do. So basically, worldwide liquidity injections in play. You're going to top various peak levels in the market. In the shorter term, within the calendar month, is that at some point, up at the upper end of where that resistance level is, there will have to have a fairly decent contraction when that comes. The markets will decide that. The news, the headlines, the liquidity, everything I'm telling you about, where it is not a great world out here. Otherwise, they wouldn't be doing what they're doing. And let's just call a spade, and let's use the correct reasoning and thinking together as we are, so that you know, I know, but so that you know where we're at within the calendar January 2012 period in a full-blown earnings season. A lot of them have been marked down. A lot of them were already marked down prior to going into this one. So in order to get stability in the economy, within the deleveraging, everything is marked down to a level where those capital injections actually start to take place thereafter, meaning that they start to get their effects, okay? So basically, yes, you can buy the numbers for a period of time. It would be the time that when these things are in play, when you do get your pullback or contractions in markets, you would look at those support levels, knowing that you got this behind you. And please listen to me, because you want to put this to your benefit naturally, and that you could get in good levels and good names and take advantage of the markdowns, so that you've got more support right now when these worldwide events are going on and these very low growth environments, and you got everyone coming to the rescue simultaneously. That is my morning update. Futures are going to continue to gap higher. Dow is up 66. Gold is up 26.9. Deutsche Bank is up 59 pennies. That's a major one. Part of your liquidity injections is to save some of these central worldwide firms, broker-dealer, investment banking firms. They've all been marked down, and they've lost many billions. And now what's happening is they're trying to come back and get that money. So what the Federal Reserve and central bankers really are saying is, look, we're going to try to mark up the asset, but remember, this is just all the beginning of 1/26/2012, 26 days into the new year. And we know what 2011 was like, because we clearly forecast all of those tops, and we took every bull bottom off of the 52-week lows on all the indexes in 2011. Okay, and that's when people don't want to be bull and they run them higher. Now, how high they ever go, if they ever go to the level that you're in today, right now, as of this date and this time, is that you got a full blown exuberance working simultaneously, and at some point it will hit its highs and they will have to correct. But in the short term, people beware of where it's all coming from. And most importantly, is how you can take advantage and get the upper hand for a change.